Hello, agents. Hello, everyone. So, today, this is a really super basic guide to 5 ways to help your financial future. Super basic guide. 5 ways, a most basic guide. Number one is savings, right? The earlier you learn the value of savings, the sooner it becomes a habit. That's just easy. You like to see that money grow. It's almost a game, right? You can make it a game. Even at just 10% of the take home, a savings accounts offer a form of peace of mind. So if you just have that little bit of extra cash there, of course you have peace of mind. Hey, if something happens, at least I have a little bit of money, right? At least I got a little bit in savings. It's peace of mind. I love peace of mind. You can save for known future events, right? So if you know, hey, my bathroom's failing, I'm going to need to get one done in the next year or so, you got to start saving some money for that, right? So you don't get hit with these expenses. This is basic stuff to make sure you have a good, strong financial future, right? And this step, the savings, may be one of the hardest steps. And that is why it should start early and often because you got the money, it's going to savings. It's not doing anything. It's sitting there, right? It's not, you want to use the money. It's more fun, right? But that's why I say it's the hardest step because you got to actually be disciplined about it, right? So good. Savings levels should remain equal or increase, right? If you don't start seeing some savings or you see they decrease, you need to take a review of your situation, right? So next is credit. Credit. What is credit all about? Well, my first experience personally with credit was in bad credit. I didn't even know how credit worked. There was Circuit City. Remember Circuit City? They had a special on a 19-inch color Magnavox TV. It was like $219 or something. And I had cash. I worked, I had cash money. I went in there with the cash. And when I picked out the TV and the guy's like, oh, you want to open a credit card and you get 6 months, no interest. I'm like, yeah, 6 months, 0 interest. Sounds like good. I already have the cash. I'll pay it over time. So I ran my credit, came back. Oh, no, you're not. Your credit's like 600, whatever. It was super low. I'm like, oh, wow. Well, how do you get good credit? I didn't know. No one taught me this, right? So just pay your bills on time. So, all right, pay my bills on time. Guess what? It was the best advice I ever got. It was from a Circuit City guy on financial health. Just pay your bills on time. So I did that. Credit got much better, right? This stuff is not taught in schools about credit and how to get a good credit score. It's just not. I asked my kids, they're in school. They didn't know anything about it, right? So I'm teaching them. A good credit score can save huge sums of wasted money. And I'm going to show you an example right here of how. This is an auto loan, current auto loan rates, right? So if you look at a 60-month auto loan, there's two different values here, right? There's a range of rates, the range of rates, 6.39% to 18%. How does that? And the cool thing about this is you can figure out before you go buy a car what your payment's going to be. They give you the estimate amount. So if you borrow per $100, it's $1.95 at that 6.38% rate and $2.54 per $100 at that 18% rate. So if your credit score is in the 600, you're going to be at this 18% rate. And if your credit score is in the 800, you're going to be at this 6.3% rate, right? So a $40,000 loan amount. So let's say two people, one with horrible credit, one with wonderful credit, go to get the same car, $40,000 loan. The guy with the great credit, the person with the great credit is going to get 6.39%. The payment's going to be on the $40,000 loan, $780 a month. 780 times 60 payments equals $46,800. Now that guy that didn't pay his bills on time, got cruddy credit, little procrastinator, didn't understand how credit works, got an 18% rate for that same car loan. They really want this car. Remember, cars are emotional buys. People are going to do it, not thinking too much about 48 months down the road, right? So this person's now paying $1,016. And guess what? This is a very common thing right now, $1,000 auto payments. Not a good idea. I guess if you make 400 grand a year, it's okay. But 1,060 times 60, 1,016 times 60 equals $60,900. 46, 60. You see the difference there? Why? It's easy math. That's $236 a month. The better credit person has that's not paying that the other person is. That's $14,160 in just interest. Same exact loan, same exact car, same exact everything. One person paid their bills on time. One has bad credit. It's that simple. That's how much money you could save just in this one purchase, $14,000 in 5 years, right? That's a big deal. So one person's paying $46,000 for that $40,000 loan. One's paying $60,000. This is not uncommon. This is going on every day at every auto dealership throughout the country. So, also if you have good credit and you can get that 6.39% auto loan, let's say when auto loans were lower at 2.3 or sometimes the dealers will have 0% for 5 years or something. So you have the cash, but why? You can borrow it. You have good credit. Borrow at 3, put the same amount of cash in the bank at 4, right? Borrow at nothing, put the money away at 4, and you just made money on on their money, basically. So thank you. That's an arbitrage. Borrow low, save high. Same money. That's why money makes money, and people with good credit can take advantage of these things. So, and beware of your debt to income ratio, and we'll get into that shortly. Monthly debt to income. Hey, look how short that was. AKA your monthly nut. What do you have to spend every month? This is something that's very important. It will affect your credit score especially when you're going to get a home loan. Those are the place I've seen it pop up. Whereas if you have you're making $10,000 a month, but your expenses are $8,000 a month, and now you're going for a loan that's going to be $2,300 a month, they're like, no, you don't qualify. Even if you have $1 million in the bank, they want to see monthly income, right? They don't care how much money you have in the bank. So good credit will get you also a lower rate on that loan and lower debt to income because you've done all the other things right. You'll have a better chance of getting these loans approved. And the happiest people I speak to, and I deal with people all the time, all different classes, and the happiest people, whether they have millions of dollars or they are just averagely got a couple $100,000 in savings, the happiest people I speak with have money left over every month. They make $1,000, but they only spend $500. They're happy. You make $200,000 a month, but you only spend $100,000 a month. They're happy. The person that makes $15,000 a month and spending $18,000 a month is miserable. So it's very important. The happiest people have a good debt to income ratio. So I say the best way to do this is lay out a 5-year grid before any large purchases, especially, and plan for increases. Add a COLA every year for your basic increases. Like, fixed costs is like your auto payment that we just discussed isn't going to change. Your mortgage payment, hopefully you don't have adjustable. It's not going to change. But you do have adjustable costs such as gas, energy, your entertainment, your insurance is going up. Taxes go up, right? So you want to adjust. So when you do your 5-year plan, say, okay, my cable bill's $100 this month, so let's make it $105 next month, $110 the next year. Each year. And then you do a 5-year plan. By the 5th year, maybe your cable bill's $140 and you're planning for it. But maybe it's not, then you have, right? You have some cushion in your plan. So month of debt, definitely monthly nut, debt to income ratio, very important. And any plan that you write this 5-year can expose any deficit in this monthly. So if you do your plan, you feel, oh crud, I'm not going to be good in the months I have to pay property tax or whatever, and you lay it out. So planning is very important. Self-review, right? So after you've done all these things, you're a little bit disciplined, you do the self-review, revisit the interest rates on your savings account. Hey, I noticed one of my savings account was really good, and then they changed it. They opened a new thing called the extra or whatever, and it pays more interest than mine was paying. So you got to open the new account, move the money over, you get a higher interest rate. So just revisit it, make sure you're up. Could you refinance and save large dollars since you have this great credit? Can you refinance your so let's say the car loan we just talked about was at $780 for 2 years. You've already done it. So let's say interest rates went down. Now you have a reduced principal and you can get a lower payment. But even at the same interest rate, see here, even at the same interest rate, the reduced principal will result in a reduced payment. So if you refied that 780 at the same term, 6 years, like you're going longer again, but you want to lower your debt to income, now your payment's $526 a month. So you're saving that money. You still have the same car, right? And you're building equity in that car. So anyway, that's a way you can do a self-review. And then everyday expenses. Of course, if you call, hey, cable, you're charging me $140. I see your new deals are $79 a month. I'm going to cancel if you don't. Yeah, you can save money that way. So people, self-reviews, call these places often, and reverse any recent increases due to specials or limited time offers expiring on your cell phone, whatever it is. So self-review is very important for that. And if you can borrow money, like I said, at a low rate, go ahead and do it, and you'll have the difference. Balance transfer, if you do have credit card, don't pay 18% on your credit card. Look around. If you got good credit, even though you have a high credit card, you can go and get a low credit card interest rate, right? Sweet. Okay, so next will be discipline. If you do a review and you refi, all this stuff says, hey, if you see there's a problem, take care of it. Ability to balance good credit score with monthly expenses. Just because you have a good credit score and can provide that really more expensive car and the dealer's trying to talk to it, be disciplined. Don't break your program. The joy of being able to possess something may be outweighed by the joy of actually possessing it. So, I've had possessions that own me and you don't own them. And I don't like that. So, but building equity is not a bad thing either, as long as you can handle it. Be disciplined in those endeavors. Be logical and stick to your plan. In conclusion, do you look at these 5 ways and think, hey, I can't afford to live like that? Yet you still want to have financial happiness known as not stressing about money? Well, you do not need to have endless money to be financially happy. But if you have more than required, you may find that happy place to exist, right? I do believe as humans, we are born with a basic level of peace and happiness, along with the awareness of danger, right? So society, governmental stresses can keep that base level happiness suppressed. So money can't buy happiness, but not having to stress about money may make life feel less heavy, allowing that basic peace to make an appearance. So what I'm saying here is money is sometimes root of all evil, right? Don't get yourself buried to where it's going to make you unhappy. If you have a cushion, if you have a little room, the internal peace that just comes with being on earth, I think will be able to come out in less stress. So I always feel people that less expenses and more money are overall generally happier just because of that stress level. So that's my conclusion anyway. As you can see, this does not take into a specific event. Everybody's different. Those are some disclosures. Thanks for watching, everyone. 800-373-967. Hope you enjoyed this 5 basics. Be talking to you all soon. Thanks for watching. Bye-bye.